All right, all right. Welcome everyone to the Creative Collective podcast. We are honored to have Christian Osgood here. He is a multifamily master, and he is going to teach us how to buy multifamily with zero down out of pocket.
Yes.
He's got a great approach to seller finance and very creative. He also has a great YouTube channel, so definitely recommend everybody check that out and loves to help people. So welcome, Christian. Thanks for coming and we're really excited to have you.
Excited to be here. Love your background, by the way, Justin. That
Oh,
is
thank you.
you have tricked that thing out. That's the background I want to have one day. You got a cool studio.
Likewise, likewise. Appreciate that, man.
Yeah, it's come a long ways from the virtual office
Yeah,
background.
yeah.
So,
Yep. I went from the virtual backdrop to like a fabric backdrop that had books behind me, and now I actually have real books that I can pull out and show people. But
and pretend
yeah,
to read.
yeah, pretend to read exactly. Yeah. But yeah, so we're really excited to have you. Usually what we do is we start and we want to get your backstory and how you sort of got to where you are. So why don't you tell us a little bit about yourself?
Yeah, so I started more or less the traditional route of like, okay, I think you have to save to get into real estate. So went to college, got a first sales job at a company called Sanmar. They make apparel, so I was selling like for decorations, like apparel bags and caps, all the, like your blank stuff that you send out to whatever Nike and just general decorators. Selling t-shirts. That's
Yeah.
where I got some basic sales skills. Always wanted to get into real estate and was realizing that that was not going to be the path there. And this is where I think I made the first mistake, but I went and moved to the CoStar group. So I started selling for land.com, which was later acquired by CoStar, and then worked for LoopNet, apartments.com, selling their data product. I thought that by being around people in real estate and having a job in real estate, that was a step towards owning real estate. What I ended up doing was spending 4 years selling to owners of real estate, to banks, to property management companies. And in the entire span of that, I was making about a quarter million a year. I bought two duplexes and my little house, my 1,300 square foot house. Cash flow from the duplexes, paid my mortgage, and that whole cycle from going from apparel to one data product to another, I spent about 8 years and my real estate was paying for my mortgage. And I was like, shoot, I thought this is what you're supposed to do to be rich. I don't think I want to work another 16, 25 years of doing the same thing. Save, buy a duplex, save, buy a duplex. That's not working. So around that time, COVID hit, everything shut down. I'm an outside sales rep who's not allowed to go outside, so that wasn't going to fly. And that was the push I needed to go. Like, I sat down and I was sitting at home and I was like, I barely own any real estate. What the heck? I got into this to own real estate. I don't own anything.
Right, right.
I went to an office of a guy. I won't name drop him because he actually ended up being like terrible at business, but amazing at buying anything. And he was using creative finance to buy office space. And he had this small brokerage. I went to his brokerage, and Cody Davis, my business partner, happened to be working there. And he was the kid in the office. At that time, he was 20 years old. He just closed on his 24th unit. His 21st birthday rolls around. He's at 30 units. And I know for a fact, I've seen his bank account. He's not brokering any deals. So yeah, he's not earning any money. He has $3,000. I'm like, how are you doing this for $3,000? He's like, dude, that's the craziest thing. I still haven't spent the $3,000. It's like, okay. I know how to generate income. I know how to operate businesses. I know how to do teams. I don't know how to buy things without any money. So that's where I got turned on to seller financing. I said, hey, I have this goal. I'm 29. Cody, if you were me, how would you get to 30 units? He's like, well, I can't help you because I want to buy a 38 unit and I need a partner to run this. And that will put you at 42 units. That's not 30. I was like, okay, that's good math. We bought a 38 unit together, and that is more or less how we got started. Today, a little over 200 multifamily units. I own a seller finance resort on the water in Union, Washington. I own primarily Grant County, Washington. I also own a little bit in Texas. And we've purchased together, I've used two bank loans to acquire for small properties prior to meeting Cody and starting our business. I purchased all that without using a single bank loan to acquire. Plenty of refinances into commercial, but we bought all of it with none of our own money with no bank loans.
Wow, that's amazing.
Nice.
Yeah.
Yeah.
I think
That's the backstory.
it's
Love it.
interesting how, you have real estate agents and people like you that worked at CoStar and so on, and everyone thinks that they're in real estate, but they're really just working for someone else who is in real estate. They are working a W-2 job. They are not investors. They are, the 9 to 5ers, right? And so I think and it's pretty interesting for you, someone, further along your career, probably more apt in real estate, to then find a 20-year-old who taught you the way, right? I think that's amazing. And it really doesn't matter how old you are, it's just how creative you are and what you can accomplish in that. So that's amazing.
And the synergies there were really fun, right? You have someone who knows how to work in the corporate world, who knows how to sell and raise capital and all the skills that I had. And then you have Cody, who's like, I figured out how to ask people to help me buy real estate. And that's the whole model. And I'm sure we're going to talk a bunch about this, but like the whole thing was stop asking for the sell, stop asking people to sell their property.
Right.
Every single market, just everything you want to do, someone else has already done. For the most part, that is true. Go to the people. If you want 100 units, who in your market has 100 units? Go out and meet them and ask them how they got there. You never ask them to sell anything. Enough people who've done what you want to do know what you're trying to do. They'll give you a call and say like, "Hey, this deal's too small for me, but I think you should look at this. This is exactly what fits your pieces, and this is what I'd buy." And that's what happened to Cody and I. We learned from a bunch of people who have several hundred units. We did exactly what they said, and they took 30, 40, 50 years to build their portfolio to a couple hundred units. We had 50 people like that tell us how to do it. So we're able to do it in 2.5 years.
Right.
We just
Right.
took all their knowledge and compressed time.
Yeah.
That's all we did.
Yeah.
It's pretty simple. Find the people you want to learn from who've done what you want to do, and then just take them to coffee. I mean, that was really the method to the madness. That's the step I was missing.
Yeah. Yeah. So do you want to walk us through your process a little bit more then? Go a little bit more in depth here.
Yeah. So a perfect example. When I got started, my first duplex, so this is the second duplex I bought, first one in Grant County, which is where most of our portfolio lives. When I bought that duplex, I started calling owners who've done something I haven't done yet. There's a 20 unit right down the street. That's a perfect example. Now, most people are going to call them and say, "Hey, would you consider selling your building? Like, would you consider an offer on this?" Or whatever people do in their mailers, their marketing, all the noise out there. What I did is I said, "Hey, I just bought a duplex and I'm trying to retire my wife from teaching. I realized that I am not going to do that in any timely manner buying duplexes. You have a 20plex. I'm trying to figure out how to do this. How did you get started buying 20 unit buildings?"
Right.
And their response was, "Well, I'm not selling it." And I'm like, "Perfect. I don't have any money. I just spent it on the duplex. I am completely broke, but I can't afford coffee. I want to meet with owners who've done what I've done or what I want to do. And I'm just trying to figure out how to play the game. Are you open to me buying you coffee when I'm in town next Wednesday?" That was the call. And we booked the meeting. And guess what? They didn't sell me the 20 unit building because that's not what we met about. I learned about how they bought it. I learned how they use creative finance, and they connected me to another person in town who were like, "If you're starting this game with no money, you need to talk to this guy." And I booked a meeting with that person off of their reference, and him and his partner put Cody and I in their truck. And this is a relationship that Cody already had too.
Mm-hmm.
We hopped in their truck together. They drove us through the entire portfolio, and they said, "This is how we bought this. This is how we partnered for this. This is where we use creative finance over here. And these are the rules that we have." And I was like, "Oh my gosh, we need to do this with everyone." So we met with the rest of the owners in that town over the course of about 3 months. Everyone who owns anything significant plopped us in their truck, drove us around, and all of those people said, "Hey, I'm trying to scale up. You guys are trying to buy properties. Can you put together 10% down?" And we bought a bunch of properties, 10% down from the same 3 or 4 groups of people. And that's how we got started.
Mm-hmm. Amazing. Amazing. So you on your YouTube channel, you preach a lot of zero money down here, and obviously 10% down is not zero money. So how are you getting to that point?
So you have 3 stages, and everyone does this backwards, or at least almost everyone. Deal, debt, equity. Everyone worries about the money, and they're like, "Where's the money coming from?" I'm like, "Well, I have no idea because I don't have a deal." You raise money differently depending on what your deal is. If I have a really high cash flow deal, I'm gonna take it all debt with no partners because that's awesome. If the debt can be serviced by all the cash flow, let's take it out with all debt. If say it's a building with a ton of upside, our 38 plex was a perfect example of this. Ton of upside. We need to do that. That was 15% down. $2 million purchase. So we had $3,000. We needed to raise $300,000. And the cash flow, it lost money operating. It was a negative cap rate day one. That's not where you want to be. 38 units, their collections were $5,000 a month.
Right. But with a lot of room to grow, or a lot of value add, so to speak.
A ludicrous amount of upside.
Gotcha.
We took that one, our last appraisal on that building, which was several months ago before we finished doing more lease up, appraised for $4.1 million. Collections right now, we're bringing in about $30,000 a month. So we brought that in 2 years from $5,000 a month to $30,000 a month. That's what we call very good for your NOI.
Yeah.
That's awesome, dude.
Yep. And that was a deal that was sitting on market, by the way, for 12 years. So when you put together deals like this, it's like, okay, day one, I could not buy that with debt because we were already negative on the deal. Like you can't support negative money with negative money. What we did is equity. I went, okay, this has a ton of upside. We're going to buy out all our investors in 5 years. And we can double all their money in 5 years very comfortably. 300 in, we have to write a check for 600 in 5 years, and we project the deal is going to make $1 million. It made 2, but our projection said 1 million. I'm like, we both make $200,000 with none of our own money if we do this deal half right. I think we go for this. And that's what we did. We ended up buying out the partners before the end of year one. And advice to everyone, if you do a buyout in 5 years, you should probably do like a tiered system. So if you buy them out early, you don't have to double their money, because that was So we ended up basically borrowing at 100% interest, which was is functionally what we structured for ourselves. So there's a lot of stupid tax you pay when you play the game, when you're first learning how to play the game. However, despite the fact that we basically overpaid by $300,000 for the debt, we made 7 figures. Like Cody and I each got $1 million of net worth out of this. We pulled out over $1 million of cash from this property. I would say we failed forward very well on this. Like this was our first deal together. We made mistakes. It was still okay. Was it perfect? Absolutely not. $300,000. The amount of times I would have loved to have that money in our account would have been fantastic, but it's not the pieces that we had.
Right.
When you structure the deal, though, that is what you're finding out. You go, deal, what is our opportunity? What is the debt available here, and what can it service? And if we've maxed what we can do with debt, do we bring on an equity partner, and how do we match the right person to the right deal?
That's amazing. Can I hop in real quick, Justin?
Yeah, go for it, man.
I kind of wanted to ask you, Christian, what took you from the duplex mentality to jumping into your first 38 unit deal? What happened with your mindset there, that shift? Oh, can you mute this? Can you mute yourself, please? Did you get that? Guys,
I got it.
you got it. Thank you, sir. But what was that? What took place, when in your thought process to get you from duplexes to 38 units? Was it a partner? Was it like, were you just ready to go? Like, what did that look like? Can you walk us through that a little bit?
Yeah, for me, I think it was simpler for me than a lot of people, because I was a sales rep. My wife actually got injured. She was a kindergarten teacher. She got pushed by a kindergartner. In Seattle, they don't do anything for you if you get injured. So she had displaced her hip. She got a pretty major injury. School district did nothing. And I was like, we just have to get her out of this job, because she was she was like, I think it was like 3 months recovery. And it was just absolutely terrible. Also, our politics are ridiculous here in schools already. So they're rolling out some curriculum that did not agree with our ethics. And so we were like, okay, we have to get her out of this job. And it went from, hey, we have this 10-year goal of putting together real estate and one day getting her out of teaching to like, okay, our 10-year goal is a 1-year goal. I can't do that with 2 units. So we have
Mhm.
to think bigger. I remember when I first brought up the 38 plex, I was like, how comfortable are you doing this deal? Because there's a personal guarantee on it. So I'm like, technically, we're backing it with our house if we're wrong. She's like, well, I want to build the business more than I want to own this house. So I think it was about a 5-minute conversation. And she's like, I'm 100% to go. I'm like, I believe in this deal too. There's a lot that we don't know, but I think we're right. And I believe that we can get this done. And so we did the deal and it worked. And then we did within 3 months, we bought a 6-plex and a 7-plex seller finance, super low money down. And I was like, oh, they all keep working. The whole principle is buy it on cash flow with long-term fixed rate debt. I'm like, huh. Every time we close these, we get paid more every month for a long period of time.
Nice.
I don't see a flaw in the model. It doesn't care about market conditions. I don't care what debt's at right now. People thought we were stupid for borrowing at 6% seller finance when interest rates are 3. When interest rates went to 8, I'm still paying 6%, and I got great prices. So for me, it just is like, let's buy an income stream and let's maintain that income stream. And if we do that on every single deal, every time we close, my monthly income goes up. It's that simple. That's how
That's
we underwrite.
awesome,
How do
dude.
we own it? How do you never lose it? You don't stop making money on it.
I love that, man. So were you working a W-2 at the time, or were you full-time already in investing when you pulled the trigger on that 38 unit?
I left my W-2 right after we closed the 38, before it was making any money. I left the W-2. My wife left her W-2 11 months later. So she was a teacher making 80K a month or a year. 80K a month would be insane. 80K a year as a teacher. Which by the way is not nearly enough to service the debt on a 38 plex if you're wrong with your projections. But she left within 11 months. And by the end of the first 11 months, Cody and I were just about to crack 100 units in our portfolio. We bought a couple of 12 plexes, bought some 6 plexes, a lot of mid-sized, like small mid-sized multifamily. But that's where we started. And almost all of them cash flow day one, but were fairly heavy value add projects that we had to do out of cash flow over time over the last few years.
Nice, man. That is an incredible story, man. I love it. I love it. There was a big need there, right? That's what we
Yep.
look for a lot. The need, what's the need? That's amazing, man. I love that. And I'm from Eugene, Oregon, by the way, too. So I'm in Texas now, but I know exactly what you're talking about.
I
Um,
just poured foundation on my house in Texas last
did you?
Friday. So
Nice.
I'll be down there. What part of Texas are you in?
I'm in East. I'm a couple hours east of Dallas. I'm in the Tyler, Texas area. Really
Oh, there we
east.
go. I'm
Yeah.
moving to Flower Mound, so I'll be right there between Fort Worth and Dallas on the Fort Worth
Oh,
side.
cool, man. Nice. We'll
Yeah.
have to go grab coffee together. I'm gonna be over there for the Aspire event next
Oh,
week,
no way.
actually. Yeah.
There
But
we
I go over
go.
there a lot. Yeah, so we'll have to hook up, man.
Yeah,
For
I'll be
sure.
moving there in about I think August is the official. My house will be done. I'll finally be out of cold, rainy Washington.
Love it, man. So I'll let Justin take it back over one, but I wanted to ask you about the 38 unit. Like, what was the like, how did you submit an offer? Was it a seller finance offer? Was it a traditional offer? Was it DSCR, hard money? What did that kind of look like, the offer on that?
Yeah, so this one was interesting. We do a lot of properties that are not nearly as heavy value add. I don't do a whole lot of stuff with distressed sellers. Usually with seller financing, you're working with more affluent sellers who paid off their debt. That's usually what happens. In the case of this property, this was a very elderly couple who had run this property into the ground. It had bad roof. One of the septic drain fields was shot. They had almost no one paying. There was a homeless camp on the property, and there's like a chicken infestation. There's chickens everywhere. It was crazy. It was all just 2 tenants like housed all these chickens in their unit, which was also
Damn.
crazy
That's funny.
expensive reno. Yeah, it was super
This is
gnarly.
great.
So here's the pieces on this one. On market for 12 years at $2 million, no one bought it. So my business partner Cody was 8 when they listed this thing. We bought it the same price. It had a ton of problems. All of the bigger owners did not want to do the lift on that property because it was just too much stuff. All of the smaller investors weren't comfortable buying 38 units. So you really needed two people who are like, I have the time, I have the energy, I have the drive to take out this project. The upside was always there, but your buyer pool for that is basically nothing. In addition, it's not bank financeable. There's a 0% chance that a bank is going to lend on a property that costs $7,000 a month to run in operations and only brings in two. Like, no bank's going to lend on that. There's way too many problems. They happen to only owe $150,000 on it because they bought it forever ago and never refinanced it because they couldn't. So it was a unique situation where the property was distressed in a way where they had a very high equity position and they had no way to fix their problems. So the only two buyers for this are a cash buyer with $2 million in cash or someone who's going to buy it seller financed. There's the only two options to really unlock it. We
Right.
came in and said, hey, 300,000 gives you $150,000 in cash right now. And we wrote a note that was super low interest. Well, it's 4% interest, but it was basically interest only for the first 6 months. And then it kicked into a higher amortized schedule while we got collections going.
Love that.
Proposal was always seller finance because I don't
Love
have
it,
$2
man.
million and
Yeah.
they wanted to move it. So we're like, we will close it. They're like, everyone's put this under contract. It never closes. I was like, we're going to close it. I'm
Sweet.
telling you, we're going to close it. And we did.
That's awesome. That's awesome. So you pick up this 38 unit, and can you just kind of tell us about how you start to pick up steam with all your acquisitions? I mean, it is, I think your approach to this is unique because everyone is going out there and they're so deal based. So, do you want to sell your property to me? Do you want to sell me your property? You're going out and you're talking to people and you're fostering these relationships. And so while there is no immediate gratification in finding a deal, you guys have this sort of slow burn of building these relationships with these people that eventually pay off, right? And so
Yeah.
how is it that you guys found out that this was the approach that you wanted to take?
For me, well, it's like, what pieces do you have? And that's really the part of any piece of real estate. You have three resource pools. So think about this like a board game. You have liquidity, you got cash flow, you have equity. If you don't have any liquidity, if you just don't have money, that's just not a piece that you're allowed to play with. So what strategies allow you to play with that? You're going to have to get creative. Creative finance is like, okay, how do we take the pieces that we do have and turn it into real estate? Now you can get equity by using other people's money. So I can play without the cash flow or the liquidity. We can get creative to build equity. The fun thing is, as you start to build any one of these pieces, for a fee, any piece can be converted to another one. We've bought partners out, so we've bought with equity and then converted them, like they seller finance their equity to us later when we got the cash flow up. So you can, that's a way that you could convert equity into liquidity is, well, or vice versa. That is that's turning your cash flow into equity. But usually for a fee, or sometimes you have someone buy into an LLC, and that's where you take your equity and turn it into cash. And whatever it is, you have to be able to incentivize the other party. So there's a cost to trade your resources. But I mean, the whole game is just how do we balance our resources the best we have? If we have no cash, what can we get and what can we negotiate? And then how do we convert that into cash and convert that cash into cash flow and continue to cycle through? But that's all it is. It's a board game where you have three resource pools and you start with what you start with.
Right. Yeah.
And if you need more pieces, you need to have more relationships with people who have the pieces you want. It's kind of like Settlers of Catan. It's like you only have so many resources and you have people and you can trade.
Someone says that they love your strategy, but finding deals, but find it challenging if virtual. And I just want to speak to this because I've been watching and listening to your stuff and implementing and pulling some lists. And I live in Oakland, California, but I have partners out in Oklahoma City. And we pull some lists, and I scan that list for people that actually live in my area who invest in Oklahoma City, right? And so you'd be surprised how many people are not necessarily investing in their market. And so you can go out and it may be a smaller pool of people, but you can go out and find those people that live in your area and invest in the market that you want to be in. And I think also, taking trips to your market, quarterly or whatever, and saving those meetings for that time frame is also a good idea. So just keep that in mind there. So yeah, so the 38 units has then snowballed into all these seller relationships that you had. So how fast did you I mean, you've gone from 0 to 200 units in 3 years at this point, right?
Been just a little bit less than 3 years. We bought
Yeah,
the 38 plex in October of 21. So
yeah.
we're sitting right around 2.5 years.
So how how long from, your initial outreach to maybe someone offering to sell you a deal after you have cultivated this relationship? What are you seeing the lag in that time frame usually?
It usually takes a few months to a few years. A couple of the people who seller finance to us early, Cody bought his first 12 plex in 20 beginning of 2020. And so some of the relationships came through where he had bought a 12 plex and that person came back to us. So we had one relationship that's been cultivated a little bit longer than I had joined the a little longer than I joined the party. We had the person who actually sold me a duplex before I even bought the 38. The broker who sold me that owns a few hundred units themselves. They ended up selling us the next deal, which was 6 units on the same street I bought my duplex, 3 side-by-side duplexes,
Mhm.
900,000, 10% down, and 90K raise. It was a great deal. And they're super nice. There was nothing wrong with them. They have enough money. So they're like, we don't need money. We need less units right now. We're estate planning. So that one was an easier transaction. That happened about 5 months after I met them, and I'd closed the transaction with them as a buyer. We'd driven their portfolio. They talked about their partnership. They proposed that as a possible project, and a few months later, they came back to the table and said, "Hey, we have one other partner on this. They're actually ready to liquidate. Do you guys
Right.
want to try doing a transaction together?" So the owner thing's not immediate, but it's not like it's going to take you years and years and years. Like
Right.
people are moving their pieces. I look at it like this: if you make one call a day to an owner in your market, on average, you're going to get one or two people to say yes to a coffee meeting, which
Right.
means every weekend I can meet one or two owners in a market. So 50 to 100 people a year in my market, if I spend 1 year doing this, will know who I am, what I'm trying to do, and I've never tried to buy anything from them. I've just tried to learn. That is enough points of contact where you're just going to have deal flow. You never have to ask for it. And we never have. I've never asked anyone to sell a property before.
Yeah, that's amazing. Yeah, great advice. I think that, and I think it's all about communicating your need, communicating or cultivating a relationship, and then just continuing to work on that, and it seems to pay dividends. I think that's really impressive. Um
Mhm.
so you have a really unique view on debt and something called the debt hammer. Can you go into that? I love this strategy you guys have
Bring
here.
the hammer.
Yeah.
So when I first started real estate, I thought there was 3 phases, and we were wrong. I was build phase, where you buy enough real estate to hit your goal. There's stabilized phase, where you take all those things, and they happen concurrently. You're stabilizing the first projects as you continue to build. But the stabilized phase is where you get everything performing the way it should. So like the 38 plex, bringing it from the first 5,000 a month to $20,000 a month. That's where it started to be like, okay, this is now getting stabilized and this is doing well. Then we resided, redid roofs, we did a ton of projects on it. Went to stone countertops and over improved it, which is a story for another time. That's
Yeah.
not a best practice, but we made it way nicer and we stabilized the asset. I then figured when you have a bunch of stable assets paying you, you can just pay off the debt. And so I'm thinking like Dave Ramsey debt snowball, chunk it down over time. And we ended up with the same original problem that we had, which is I'm like, that scales too slowly. I'm going to be normal retirement age when I retire. If the goal is freedom, I can't just pay down my debt out of cash flow from stabilized multifamily in any reasonable time.
Mhm.
I met with another bunch of big owners. I'm like, how do I solve this problem? I called everyone I know who's been in the game a long time or who has paid off their debt. And I found a strategy I believe is the best strategy. First, when you're stable and you're cash flowing, you optimize. So if there's any units in your building, like maybe you have a storage room that should have been turned into a unit, you add a unit here. Or maybe you have a big parcel of land in the back, maybe you go ahead and build 3 more units or 5 more units on the building. You have a flat roof, maybe you take it to a pitched roof. You have baseboard heating, you might come in with mini splits, which is going to lower your NOI a lot if you're in a building where you're paying utilities. Bring your electric cost down. The optimized things are things like that, where it's beyond stabilizing. It's like, we can improve this and increase the value of the building and increase the cash flow. Once you're stabilized and optimized, you have a ton of cash coming in. Last problem that we solve, and this is the debt hammer. Sorry, you have to explain the first 3 steps to get to the hammer. Otherwise, you have no idea how the heck you just built a hammer of money. So you've built your hammer now. How do you use the hammer responsibly? You want to adjust for risk. So if you are doing the debt snowball and you're paying down things on an amortized schedule, the risk is on the lender. So as you get more equity in your portfolio, as you're paying it down, if you lost the property after you put $1 million in it, you lose your $1 million. If you only had $10,000 in it, you lose your $10,000. The risk, you keep the risk on the lender until you have enough money set aside to pay off your mortgage in full in one shot.
My God.
So for me, it's often a duplex. You are a smaller building. You have all these different buildings. You go, hey, right now we have like $30 million of real estate. I have a couple of notes that are $120,000 on a building. You save $120,000, you whack that note. Now the debt no longer exists. We've eliminated the risk. My cash flow has gone up because I no longer have that debt to service, period. Simple. And you do it again and again and again until you eliminate all your debts. And what you end up with is the most efficient way to own a boatload of real estate that you levered with none of your own money, that your tenants paid off in the most efficient manner, risk adjusted. It's just an awesome strategy. And I got that. That's not just like Cody and Christian are smart. Like I just interviewed everyone who's won the game, and that seems to be the strategy that consistently wins the game.
You ripped off and duplicated, right? You didn't
Yes.
reinvent the wheel.
And we
That's
did it
right.
with like hundreds of people. Like I think really if you boil it down, it's like, are Cody and I the best multifamily operators? No, there's stuff that I miss all the time. We're just like really good researchers, I guess. Like we just did a large market survey of people who've won real estate. And then we're like, what are the common themes? It's these 4 steps. Just do these, and it's really hard to lose.
Christian, I have to say, I love the terminology "whacking off the debt." That's amazing. That's my favorite so far, dude. That was dope. We're gonna whack that debt.
Are you doing this on chunks of properties? Like you come up with a goal of 50 or 100 units and say, okay, this is our portfolio that we're focused on, and we're in this phase of this portfolio. And as you go along, you get through your pillars or tenants of operating, and then that's when you start paying off your debt, and then subsequently you're working on a separate batch or a separate portfolio. Is that sort of how you're going about it?
Yes. So essentially, I want to be standing on a solid debt-free foundation as I go into the next phases. So you set a goal and you buy enough real estate. So build phase is dictated by how much real estate did I buy? Did I buy enough real estate where when it's stabilized, I have my cash flow goal? So for myself, I had 2 goals: retire my wife and build our dream home in Texas. It's not like a crazy dream home, but it's notably larger than my current home. We went like, where would we like to start a family, and what size house would we like that to be? Those were the 2 financial goals going in. For me, $25,000 a month, which was about my best commission sales month.
Mm-hmm.
I was like, if I had my best month every month, I would never have to worry about money again, and I could hit my goals. So that's how I determined my cost of financial freedom. I'm like, it's having my best month every month automatically. So let's buy enough real estate to get $25,000 a month in cash flow. For me, that was being 50-50 with Cody on at least 100 multifamily units.
Mm-hmm.
Once we got there, I'm like, okay, this portfolio, I'm not relevering. I'm taking my cash flow from all the rest of my business, and I'm going to start hammering these properties first. And I'm going to pay off this block in whole without relevering. Now we start setting up new goals, and Cody and I go like, okay, well, I mean, this is really fun. We want to teach more people to do this. We should take on some new, more challenging projects. And I got really passionate about the one thing that I think we're best at, which is entry level housing. We're super good at it. I can buy 1950s buildings. I can make them nicer than every single crappy unit around them in their neighborhood, notably nicer. And I can do it at a scale where it is cheaper, so I can keep my rents lower than my neighbors. So I can come in $50 to $100 under market rent, help affordable housing, work with housing authorities. We really get to fight homelessness by doing excellent spaces affordably and profitably. And that's where we absolutely shine. So block 2 is, how do we actually control one bed and studio rent in Moses Lake? That's the goal. Let's just buy enough of it where, like, when I'm like, okay, rent is now $1,000 a month. We have enough units where I can raise rent simultaneously. And for you math nerds, if you have 200 units and you increase your NOI by $100 per unit instantly in a 6 cap market, that is what we call a boatload of money. You make millions of dollars of equity instantly.
Yeah. So
When you
you're
raise rent
you're essentially
$100 on, $100 on 100 units is $2 million of equity created at a 6 cap.
I'd like some boatloads of money. Anyone else? Anyone else want boatloads of money in here? Yes.
And that's how you do it.
yes.
You get a large enough portfolio where raising rent $100 makes a difference.
Sick.
And then you control when rent goes up $100. And if you have control of that,
Mhm.
that's awesome. Then optimization is kind of the other side of that. If you're like, if I have a way to reduce my expenses across my portfolio by $50, it's like $1 million.
Mhm.
It's like magic.
Yeah. It's
That's why I think
genius.
it's so important to scale too. But I'm going too many directions with this, so I'm going to shut up.
so do you find that you
Hey,
move
Justin. Hey,
Yeah.
Justin. Do you mind if I jump in really
Yeah,
quick?
go
man,
for
and
it,
just
Damon.
ask- Yeah, because he was talking about stabilizing. So you come into the properties and you're in the stabilization phase to create, more revenue out of the property. How are you going about stabilizing? Are you bringing in private money, or since you're in a seller finance deal, will you try to go do some sort of like a bridge construction loan on it? Like how are you going about, finding the money to get stabilization to improve revenue?
Mm,
So
great question.
yeah, and I did this wrong originally, so I'm glad you asked that, because I had no mentor doing this, by the way, so I had to, like, Cody and I figured this all out by, like, interviewing people. There wasn't one person who was like, here's how you play the game. We just kind of pieced it together. We figured out how to buy them $0 down and how to get them to cash flow. Originally, we did a lot of our renovations out of cash flow. So as money came in, we renovated a unit. Now income's up a little bit more and cash flow's up a little bit more. What I found is the most expensive thing that you can do is not immediately get all of your livable spaces livable. Vacancy that you're just not addressing is so ridiculously expensive, and renovations can be really expensive. So the right way to do it is, when you do the deal debt equity piece, you fund your deal and the initial renovation, at least enough to get it refied or get the rents up enough where your income will now carry you through the rest of the project. We're converting a couple of hotels to multifamily right now. I just bought a 33 unit, not seller financeable. It's worth about $3 million. I think a little north of that, but we'll say conservatively 3 stabilized. Realistically, even the small studios go for about 100,000 a unit in my market. We bought it for $1.6 million. We got a hard money loan at 13.5%, but they gave us $1.8 million. I need probably about $400,000 to renovate it, but the $200,000 extra dollars on the front end is enough to get all of the interiors renovated, which means I can lease the entire building. It's going to be cash flowing thousands of dollars a month with 13.5 interest debt. And I have a lender who's ready to bring it to 9%. That's enough to start cash flowing and finishing the exteriors, redoing the lighting. We're adding a community garden. We're getting far enough on it where that's enough money to do the renovation. So the correct answer is raise it on the front end so you have the money to lease your spaces. What we actually did, which was super expensive, is we did it out of cash flow. We did it 1 unit at a time. When we stabilized enough, we got a bank loan, we refinanced, we pulled $300,000 out, reinvested it in the building, needed another $300,000, but had renovated enough where we got to go back to the bank and do another bank loan and refinance again and pull out more money. You pay points for that. You lose time doing that. You have vacancy doing that. Again, we made 7 figures, but that is in spite of doing it wrong. That's not, because we were making a bunch of good decisions. We were learning along the way. We did a deal that was good enough on the front end that afforded our stupidity is what we ended up doing.
I love that. That's great. That's amazing. I love it. This is gold, man. This is gold. Like this is giving, I think, a lot of people hope, right, bro? Like that's what you're doing. Like you failed forward, literally failed forward,
Yes.
and
You
still
will
made a
make
boatload of money.
Yeah, and you'll make mistakes. We call it the stupid tax. This is we bought a resort. We shouldn't have done that either because I found we're amazing at value add multifamily. Just because it's the problem with creative finance, and a lot of people run into this problem when they get in seller financing. You learn that you learn how to buy anything without money. So you're like, I can buy anything. So then you buy everything. Just because it makes money doesn't mean it makes sense. My best advice I think I've received, and so I pass this to everyone, is find the thing that you could be the best in the world at and then do that. You don't need to be the best at everything. You don't need to be good at everything. Find what you're amazing at and do that thing. And I'm like, we are so good at making like nice, safe communities for low income housing and being ridiculously profitable doing it. If I could go back in time, I would have never deviated from that. And when you do that mistake of like, oh, whoa, this takes a lot of time. We hate hospitality. Make sure you buy a resort that costs less than $4.5 million because $4.5 million, granted, it makes money. It's actually doing well financially, but we don't like running hospitality. And there's not like an easy out for like, well, find another buyer of $5.5 million. It's like, we're kind of stuck until we finish the project. So
Besides,
limit them.
besides the desire to buy anything because you know that you can, what was the mindset behind buying hospitality, buying this resort?
So it's waterfront, it's in the woods. It's probably the most Pacific Northwest thing you could have. Foothills of the Olympic Mountains, 12.5 acres, 18 individual cabins with hot tubs, giant wedding venue. Like when you're talking to like a budding entrepreneur, it's like,
Sounds awesome.
holy crap. And if we're being totally transparent, there's a certain amount of like, dude, the marketing we're going to get from this, people are going to think we're amazing. Like, there's a little bit of the cool factor of like, instead of owning a bunch of value add multifamily, people are going to watch our YouTube channel and be like, holy crap, they bought what? So, I mean, there's the excitement of like, this is a trophy property. We can make this cash flow. We definitely had a lot of room to improve operations. So I was like, I think this thing can do a lot better than it's doing. The numbers work really well day one. And then what we found is I took all of my multifamily players and I put them in positions where they aren't going to thrive doing multifamily. Like my skill set is broad spectrum business operations. I can place a vision, I can market a vision, I can see the pieces and get it done. When you take all your specialists in multifamily and you put them in broad positions in hospitality, everyone did not do super well in their roles. And that's my fault because you got the right people on the bus for one thing and you put them in different seats on a different project. It's like, oh, well, of course that didn't go to plan. So you ended up with a bunch of stressed partners. We bought one of our partners out because they were having a hard time with the project, and it just ended up being a huge time suck. Had we just not done that project, we easily could be at 400 or 500 multifamily units with way less effort because I own a property management company. I own the brokerage. Our systems are awesome for that. We could have scaled way more and we didn't because we got distracted with shiny object syndrome. So
I'd love to touch something on that there that you just said. You said it's my fault. I want to make sure everybody catches that. You took ownership, man. Like if something's going wrong in your business, ultimately we have a tendency to blame this guy, that guy, and so like a big part of I think being a successful entrepreneur is learning to take that extreme ownership and realizing that it was your mistake getting into the project. You knew that your team was operating in a different system environment. And so I love that, man. I just wanted to point that out. It's so big. I've recognized that several times in my life and I'm like, damn, I used
And
to be
it's
that guy. Oh man, the employees, the freaking idiots did this again. And it's my fault for not putting systems in place and processes. And, I love that you said that, man. That's awesome.
and that's how you successfully get out of situations. Like you will make mistakes investing. Like fortunately, the only deals that we've had that didn't do what they were supposed to were super small deals, and so they were insignificant to our portfolio. We were blessed that when mistakes were made, they were affordable mistakes for the most part.
Mhm.
So as you're building your portfolio, you're making mistakes. Other people will make mistakes. Like there's a bunch of mistakes that my team made. But if you take a step back and yeah, like you said, you just ask yourself, okay, what could I have done differently to influence this outcome? You put everything in 3 buckets. This has worked for me really well. I got this from a mentor who actually had no business ethics, but had a bunch of really good sayings that I took. You have things you can control. You have things you can influence. You have things that you can do nothing about. And this is how you manage your stress, by the way, as you go like, okay, could I have controlled anything directly? Like, is there something that I failed to do? And let's own those things first. Like there were action steps that I could have taken that I just didn't control. And are they controllable now? Can I step in right now and fix this? There are certain things that you can't do anything about, but you can influence. For example, we had some pipes burst at a building. I actually had 19 of 24 units in one building had the pipes burst. We had the coldest month we've had in, I think, 45 years. Building could not handle it. I can't fix the pipe leak. I am not a plumber. I'm not capable of doing any of the work myself. But I can get the city in there to shut off the water. I can get insurance rolling. I can get contractors out there and I can figure out what is our plan and how do we turn this into a positive. At the end of the day, I think I think insurance is actually going to make this a better building than it was ever going to be. We're renovating it. Insurance rates will get jacked on this building. So now instead of a long-term hold, I'm like, we're going to make a beautiful building. I'm going to lease it up like we were supposed to. And I'm probably going to sell it to someone else who's going to get a better insurance rate now. And that's what the project's going to be. But you look at your pieces, I can influence it. I can't control what happened. The heat was on. We did everything we could to prevent it. There were no mistakes made. It just happened. There's certain things that you can't control, and it's good to identify those. Like sometimes someone who you had every reason to trust and you did all the due diligence on, you did everything you could, steals from your company. Or a partner changes their goals and goes rogue. And you can reflect on it, and you're like, huh, there's actually nothing I could have done. And it's just good to know those things because you need a factor for them in your math when you move forward, which again means you kind of have some influence over that now that you've gone through it. So that's a long way of saying that's the most valuable thing that I think I've learned in business, where like how to categorize those 3 things. It forces you to take ownership even of the things you can't control, because there's always something that you do the next time that makes it so you can control those things better.
That's so good, man. I'm actually stabilizing my first mobile home park in Midland, Texas. It's oil
Ooh.
field country, so 42 pads. It's been an experience, a lot of learning going on, and we're getting close though. A lot of, like you said, it was very poorly managed, and it was just a dump seller finance deal, interest only for the first year. I was able to negotiate on it, but it's been a wild ride. It was like basically the photos versus when we walked the park for the first time. I felt like I just walked into Tijuana. I was like, whoa, dogs, vehicles, like couches, like in the yards. I was like, oh boy. So, but
How many
anyways,
units was that?
42 pads.
Oh boy, how many drug problems so far out of
Yeah,
42
right.
pads in Midland?
Yeah. I don't know yet. So far nothing, but I'm sure there's going to be some
I
stuff
got
going on.
That's about a 25 unit mobile home park over actually really near our resort. When I walked it, I was like, well, and also we're in Washington State. So, and you're from Oregon,
Yeah.
so you're familiar with this. We
Yeah.
have such a bad fentanyl problem here.
Oh,
As soon
man.
as I walked in, I was like, yeah, we have a fentanyl problem. That's
Yeah.
why we picked up 25 units for $375,000 on the water. I was like, this is too good to be true. I'm like, I see why they bailed. All about your comfort level. I can handle drug
Yeah.
problems. That doesn't mean everyone wants to handle drug problems. They are gnarly, and some of the tenants are pretty scary in some of the buildings occasionally.
I'm sure. That's awesome, man. You're amazing. Your story is amazing. Your testimony. I love how you articulate everything. I mean, you've been a tremendous value tonight, and I appreciate your time, bro. Like, looking forward to meeting you and probably seeing you in Cancun at the very least. But did you guys want to open it up for Q&A, or Justin or Juan, or did you guys have anything else you wanted to go over?
Yeah, I think before we do that,
Okay.
I think we tend to ask this question a lot because I think it's a good, just a good thing to sort of reflect on and also give some advice to the people in the room that aren't where you are, right? And so, what advice would you either give your former self when you're just starting out that you've learned along the way, or someone that's just starting out that's in this room?
This is gonna be like the most basic, stupid thing ever, and this is what I needed to hear when I started. You're not a real estate investor until you buy a piece of real estate. Like if you want, I had so many steps that I added to go from point A to point B, like go to college, get a job, get a sales job, read all these books, go to all these podcasts, attend these seminars. And at the end of the day, I'm like, oh, buying real estate was very little like anything that I learned. It was, but you pick it up really fast when you have the 38 plex. You're like, oh, sink or swim. If you have a goal, just identify what are the steps for me to hit that goal and then just go do that thing. And I think that's the difference between, honestly, that's probably the biggest difference between Cody and I think a lot of other people in the real estate space is we were just a little bit younger and a little bit more aggressive on like, I defined what my goal was and then we just did the things that we needed to do to hit the goal.
Mm-hmm.
It's the most basic thing ever. And I think it's where almost everyone gets stuck is they need to add steps.
Mm-hmm.
You go from first grade to second grade, then you have to pass that to get third, middle school to high school to college, first job to second job. I think we're like programmed, like we have to add steps to this. Like, I want to be rich and be in real estate. So let's just buy deals that make us a bunch of money. I mean, obviously it's more work than that. It's a ton of work, but
Right.
it's not more complicated than that. It is that simple. That's what I love about real estate. It's stupid simple. Buy things that make more money than they lose and then do it repetitively. Like,
Yeah.
One of my favorite sayings is it's simple, but it's not easy.
yes.
Simple, but not easy.
It is a ton of work. And as an added bonus, most horrible crime happens domestically. So if you have 200 units, like you deal with some heavy stuff. Like it's not like, oh yeah, we get all these checks. It's like bad stuff happens over, 300 people living in 200 units. You deal with a lot of stuff. You have to have pretty thick skin. It's a hard industry, but it's lucrative and it's very simple. Like stupid simple.
That's awesome, man. I'm gonna. Nobody's raising their hand. Guys, raise your hand if you have questions. Your virtual hand, not like hi me. Raise your virtual hand if you have some questions.
There's been some good ones in the chat, so I definitely
Yeah.
get those addressed.
Yeah, we can just read them off. That's what I was thinking too. Just if you want to just read one off, Justin. Oh, there we go. Casey, she had a good one. Casey, come on up. Go ahead and unmute yourself.
Hey y'all, how's it going? Thank you so much for tonight. I'm, taking lots of notes. And I love I want to do something with like properties with a purpose. And so I love that model too. At some point you mentioned something about property management, and so I just wanted to clarify, did you start your own property management company? Did you buy one? Did you utilize someone else's services? How are you doing this with so many units in different places?
I started my own property management company. It's not because I want to. Property management is hard and low margin and generally speaking terrible. And most property managers are bad at it because you have to be left brain and right brain. Like you have to be good at showing units and hospitality and leasing and marketing. You also have to be incredibly good at bookkeeping because at the end of the day, there's a ton of regulation around it for good reason. So property management, don't recommend people get into it. For me, there were no good managers in my market. So Cody and I started a property management company. Of the two of us as partners, I'm the operator. Cody is a fantastic deal finder, does a lot of great visionary stuff with our portfolio. So for me, I ended up eventually buying Cody out of that company, as I have most of our companies. And I just found that I like managing the employees and do a more efficient job of that piece of the business. And Cody's really good at working with the banks and doing refis. So we split things up a little bit. That was what we ended up doing. My wife left teaching and works in the PM company full time. So a lot of our, by a lot, I mean all of our contractors are managed by her, and there's a ton of them. And yeah, we just kept building out a team and adding pieces. But it took some time, and not the route I recommend unless you have to do it, which is where we're at. I need control of the units to do our projects as fast as we do.
I think especially in the C class properties that you guys are working on, it's a challenging asset class to be in without the full control or having just a rock star property manager. I think you know, you see a lot of people in the multifamily world actually vertically integrating property management into their businesses. You know, they might partner with someone that owns a property management company and gives them a piece of their business or something like that. But it's hard. It's hard to find good property managers, right? And when you do find those, you hold on to them for dear life because they you know, they can make or break a property for sure.
Mm-hmm. And
Yeah.
what I've seen most people do is, generally speaking, if you're using creative finance, you're going to be playing a lot in the C and B minus property range. That just happens to be a lot of them, because people with a ton of money like holding Class A finished buildings with on-site management. Like, that's what you try to graduate to. So most of us will make our money in that range. And at some point, you build a big enough portfolio to 1031 up, and you buy a few 75 to 150 unit Class B to A buildings, and you're done. You're done. You have generational wealth and on-site management, and congratulations, you've won. That's the final step that most people get to when you go all the way through.
Yeah.
But it's like, on the way there, yeah, property management's super hard because they are just very active, very, you know, they're needy properties with unusually needy tenants, and it's not their fault. It's just, it's where they're at. A lot of it is entry level to, you know, mid-level housing. There's
Right.
people are not usually super rich, and so they have a couple of problems with, you know, their neighbors, their maintenance. So there's just a lot of stuff that the buildings has to go into them.
Yeah. And then you throw on an extra level of, you know, maybe Section 8, and that's a whole nother thing to navigate. So that becomes
Absolutely.
more challenging too.
I got a question for you, man. Did you try out some property management companies and realize they were just complete crap and then start your own, or what? Or how did you come to that conclusion?
So the
Yeah.
first property management company we used, the owner of the company spontaneously stole the rent, stole the security deposits, bought a
Oh,
plane, and
whoa.
moved to Texas.
Holy smokes.
I thought it
What?
would be somewhere like Colombia.
That was
Damn.
our first one. So then we started self-managing, just Cody and I, about 75 units. It was just me and Cody managing 75 units, with one partner from my old firm. She came in and assisted us, but it was just us for some time. And then we would try to buy buildings with bank financing in our county, and we had like 3 deals fall apart because their bookkeeping was just unbankable, and they were all with different property managers. I'm like, how do all of these property managers keep such bad books that we can't physically buy a building? That's ridiculous. And so we went through that, and we came up with the conclusion of, okay, no one can do this better than us. So let's start building out systems and building a team. But yeah, it took us 1 really bad experience and two or 3 transactions where, like, okay, their bookkeeping's terrible. The biggest property management company in town is the one that managed the 38 unit that we bought. That was bringing in $500 and had all those problems, or sorry, $5,000 a month over 38 units. I was like, well, we can't use them, and they're the biggest and best in town. So we did not have another option. So we built out our own systems.
Man,
Y'all are
that is.
moving. Oh, yeah.
Whew. No, go ahead.
I was just following up, since y'all are
Mhm.
moving and y'all won't be there anymore. Is that changing now? Like, are you transitioning to building out a team to do it for you when you move at the end of the year?
I've scaled the PM company to enough employees, and we manage enough third party now where our portfolio is about 3.5 hours away from me on the other side of the mountains. I go probably once every other month. I'm not
You're not just doing your
physically.
own, you're doing other, like, it's like, okay,
I
not just your
run the
own.
PM
Okay.
company. It is employees and contractors. I
Yeah,
think right
not just your
now,
own multifamily, but other people's units, other
yes.
places. Okay.
Yeah, we expanded and we have, so I manage about 325-ish units right now. So I still own more than half of my portfolio, but a portfolio of managed properties. But we run, we run a team. Property management has 5 people. I mean, I'm thinking through the staff here. Property management has 5. Our resort, Robin Hood Village Resort, has 10 staff. And then at any given time, we usually have 20 people on our general contractors team doing things throughout the portfolio. So we run 30 to 40 people at any given time that run this stuff. It is kind of crazy how fast we went, but like we were forced to build a company. So it's the piece we needed. So we built a company. It's worked so far.
Love it.
So much.
It seems
Thank
like a
you.
natural progression is a title company, a property management company,
Yeah. Oh, yeah. Title would be really
A
nice.
TC company.
right?
Hmm.
Yeah.
Yep. I'm pretty much maxed on companies. I am the CEO. I'm like the main person for 3 of our companies. I have 5 total businesses, all started in the last 2.5 years. I'm way too busy. I'm like I zero bandwidth for anything else.
Yeah, where do you find the time? Like,
I have no
working-
work-life balance. I am very public about this. I am not someone to model after. If you're like, oh, I want to own my time. I'm like, I just work. I wake up at 8 every day. I drink coffee. I read my Bible. I try to work out for 30 minutes. And then from 9 to like somewhere around 10 p.m. to sometimes 1 a.m., I just work.
Yeah.
I eat 1 meal a day. It's a huge meal, but I'm like, I am so ridiculously efficient with my time. Um, it's just like I haven't eaten yet today. I've just been like, I've been on a couple of podcasts. I've run companies. It is way too much, and it is definitely unsustainable. I just really want to get to Texas and get that part done. So I was like, I
Nice.
need stabilization. I need the companies to run without me. The journey from here to the next 6 months is so important to me that I'm like, I'm fine burning every waking hour because in Texas, I'm planning on having a lot more free time because I'll have, better trained leadership and we'll just be that much farther.
Yeah.
Nice.
Gotcha.
Yeah, it's the small, short-term sacrifices for the long-term gains, bro. I preach that all the time to people. They're like, "Oh, I have a W-2. I drive 2 hours in and 2 hours home." I'm like, "Man, that's 4 hours of phone calls, bro. Like, what do you
Mhm.
mean you don't have the time? You get that a lot. Pull yourself off your couch for your 4 hours of TV and get on the phones." But
And then
yeah,
magically you have time, right?
yeah.
So Grant had a question. Grant, do you want to unmute and ask your question? If you don't come on, I'll ask it for you. But come on up and unmute your mic if you want to ask.
Hey guys, good evening.
What's up,
Hey,
Grant?
man.
Thanks for bringing me on for my kind of simple but straightforward question. I was just curious, like after you have some success like you clearly had, and after quite some time and you've kind of, grown a lot since you initially started doing this, you're moving to the new market in Texas. I was just curious if you will repeat somewhat of a similar process, kind of trying to touch base with some of uh, the bigger investors in your new market and just try to get to know people that way.
Yep, I've already started doing that. I'm in Dallas Fort Worth pretty often. I own in McAllen and Laredo, and I'm looking at a couple projects near Dallas right now. But
Cool.
whenever I'm in town, it's the same thing. You meet with all the players. It's so simple to repeat. We had someone so in my mentorship group, one of our early mentees, his name's Caleb. He came in, he actually bought in Stephenville, Texas, which is also really close to Dallas Fort Worth area. It took him about 30 days to meet every significant player in that town. And he bought a 25 plex and then he bought a 26 plex and then he's about to close on an 8 plex. And he's been down there since November. Like,
Jeez,
and
that's wild.
yeah, one's bank finance, which is crazy. You got such a good price. He's able to bring on one partner, bank finance. The other 2 are seller finance deals. Just came in there and like, hey, I don't have any money, but I have some relationships and let's roll. And so he's the fastest I've seen anyone do it, but took him 30 days to meet literally everyone. So it's not like it's crazy hard to do. There's any given market for mid-sized multifamily, you don't have that many players. There's like per 30,000 person population, you probably have like 5 to 10 main people who own most of the mid-sized multifamily.
That's awesome. I love that. It's the someone else commented earlier, who not how, right? Finding the who's so you don't have to do it all yourself. Let's see.
Josh had a question. Josh, you want to come on?
Oh yeah, Josh Smith. Trying to hide in the comment section.
Hey, what's going on? I forget what my question was. What? Oh, can you repeat the debt hammer?
Yes, I'll do it. I'll do super bridge version. 4 stages. You build, which is how much real estate do I need to hit my cash flow goal? Stabilize, optimize, and then you hammer the debt. The way you hammer the debt is you choose usually your smallest debt, unless you have really high interest, then probably attack that high interest loan first. But you're going to pay off your one debt at a time, one mortgage at a time in full, so that you keep the risk on the lender until you can eliminate the risk entirely. And that's the debt hammer in a nutshell. Is you basically borrow to build a giant cash flow hammer, then you use that cash flow to kill all the debt that you acquired to build the hammer, and then you just have a big ass hammer and no debt, and then you won.
That's awesome.
Love it.
That's so sick.
Eric asked, how old are you, Christian?
I am 31. What's the date? Is it the 15th? I'm basically 32. I turned 32 in like 2 days.
Nice.
I know it's a high level question, so
Yeah.
I thought I'd throw it out there.
No, this is a good one. I started when I was 29.
Right
Cody is better known than me, even though we have. This drives me crazy. This is the only, I'm not that competitive, but we have the exact same accomplishments. We've done everything together, but we partnered when he was 21. So no matter what we do, he's 8 years younger, and so every single tagline of every single video is 21-year-old. I'm like, yeah, I know, I get it, but I did the same thing. It's so funny. He's my much better known partner for doing the exact same stuff, but starting at a younger age. So yeah, age is irrelevant. My the kid, by the way, in Stephenville who bought all these, he bought in Laredo at 19. He turned 21 last month.
Wow.
And he's at what is he at now? He was at 56 units. He's closing. He's at 70 something units with his 27 closing.
Wow.
Crazy. He's
Nice.
the only one who I'm like, he's building way faster and better than we did. He just did like seller deals. Caleb Hommel is someone to watch. I think he might be the next up and coming star in multifamily, because
Next Brandon Turner. Beardy
Is
Brandon.
he in Washington as well?
He is in Texas.
Okay.
He was in California. He bought all of his stuff out of state, and now he's house hacking his 25 unit. So he gets paid like $3,000 a month to live in his building.
Gotcha.
Literally, I'm like, he basically took everything that we did, but then he did it in less time and didn't make any of the mistakes. I was like, okay, you can only go perfect for so long. So he'll have something go wrong, but he's on deal 5 now. And he's only rolled. I don't know what a good roll is. I don't do anything with dice, assuming that you're going for 6. He's only rolled 6. He's like, yeah, I'm winning. I'm like, at some point he'll have something hard happen, but he literally just again and again and again, fantastic deals.
Thanks.
Awesome. Awesome, man. Thank you so much. Let's see.
Any other questions? Anybody want to come on? Raise your hand. I'll ask a question. I'm going to create a little controversy here, because you're in a room with a few sub 2 students here, or quite a few.
I was wondering if this was going to come up.
Can you give your view on sub 2 and what's going on these days?
Yeah.
I can. Okay.
Please.
So subject 2, and by the way, I have a subject 2 on my resort. One of the cabins used to be a house, and it has $75,000. It's a $4.5 million purchase. I have 75K of that is subject 2. So I want to qualify this. It's a tool that I have used. I do not think subject 2 is a strategy. Reason being, especially when you're starting with no money, you're creating a portfolio of awesome, but typically low equity deals. And if you're starting with no money and you get a note called, it is occasionally advertised online of like, oh, this is super easy to adjust. And it's usually not. It's usually very expensive to adjust. You have to go back to a seller and renegotiate. It can be kind of technical getting a note called. I don't want to create a portfolio of callable notes. I kind of think of it like syndication. I hate syndication as a strategy because you get paid up front regardless of the outcome. I like it as a option. In fact, I've looked at doing a syndication to recapitalize the deal where I think I went in with the wrong debt structure for what I eventually wanted to do. My plan changed. And so I'm like, well, what if I just bought the deal again from myself with the right debt structure? So I look at subject to like that. It is a tool that you should learn it. It's part of a land contract, which is a baller piece of creative finance. You should be able to close a fantastic deal, even if there's debt on it. So you should know subject to. What I don't like about subject to is the social media branding of it. And this is no one's fault, by the way. It's whoever's watching it and boosting the algorithm. The videos that get boosted that are made popular are the ones that are, hey, use this strategy and buy everything on subject to notes. In Washington State, and by the way, this is happening in Texas now, in Florida frequently, it's about 20% of subject to notes are being called by banks on residential, so 1 to 4 units within 60 days. And the reason that that's happening now is there's two things that happened in the last 4 years. One, there is a bank requirement that requires all banks to either have CoStar or I think it's Reonomy is the other one. There's only 2 platforms, but they have to have a data service provider. Both of those pieces of software, your risk portfolio manager can set alerts on every single property that they lend on for when title. So your bank knows when it's purchased. At least they're legally required to. Whether they act on it or not, up in there. The reason I'm on them is because when rates were 5% and you're doing a sub 2 while rates are 3, a bank has no interest whatsoever in calling it. No. Why would they do that? I'm going to take my 5% interest, place it at 3. The 3% note you're assuming, if a bank decides they would like to call it to replace the money at 7, that now makes financial sense. And we're seeing more start to do this. The third factor, seeing a ton of banks getting shut down for placing too many notes. And so I'm a bank. I'm sitting in my office going, how do we pull money back in right now so we don't get shut by the feds? Happen to pop on Instagram and see 50,000 people saying, oh my gosh, I can do this subject too. And I understand a sub 2. I'm like, should we go ahead and just mass call those? I think it's a reasonable risk. So my 2 cents on subject 2. Use it sparingly. Know how to use it. Don't build your strategy on any one strategy. Don't listen to this and say, Christian, use creative, like seller financing. I have to work with seller financing. I buy with hard money. I buy with banks. I've used subject 2. I just happen to use that as my main lever. And it's a way that I've been able to put the debt and the equity in my name. And I like that better. That's my whole spiel on it. That's the nicest I can say it. I hate the marketing around it. People are wearing my rival's hat. I mean, we're both in the space. I like Pace just fine. I have no problems with him at all. But he is Mr. Sub 2. So if we're saying sub 2, everyone's thinking Pace Morby. So I'm just gonna say Pace. Pace is fantastic. The strategy should not be the main tool in your arsenal. You should have a million ways to take out a deal, and you shouldn't put debt in someone else's name unless you have to close a truly fantastic deal. That's all I'll say.
Yeah,
I think it makes sense.
I think your
Tools
mentality aligns with Pace. He teaches it as a tool in your toolbox. 12, 15 different tools that you can use to take down a property, right? And so I think there's definitely some overlap there. And with multifamily, with what you're doing, it's not really applicable very much.
Oh, it's going to get called instantly when your commercial loans reviewed. Right. If you're buying 5 units and up, sub 2 is not going to be sub 2 is just not an option.
Yeah.
That's you go from 20% chance of getting called to 99% chance of getting called.
Right. And you get into more assumable loans rather than subject to loans.
Yep.
Yeah. Exactly.
I'm gonna have to ask Pace about that percentage number. I'm not buying it, but I appreciate you sharing.
I'll tell you how I got it. I'll tell you how I got it.
I would love to know, man.
So Pace used to text me back. Now he doesn't, and I don't know why. But when so the last time we discussed this, the numbers were looking a lot better. I did the research project, and it's a limited sample size. But if he brings it up, I got this from Stewart Title and Old Republic Title. I talked to both of them, and we ran a research project with both title companies in Washington State. I did a similar project with a smaller title company called what was it? Cowboy Country Title in Texas. And all of them came up with, they're like, it's about 1 out of 5 of these recently. So that was the common theme. I'm using a sample size of 2 states and 3 title companies. So this is by no means a broad national research study,
Got it.
but those are huge companies, and those are like leaders of those title companies who I've interviewed who gave me the statistic. So that's
Right.
where I got the data. If he
Yeah.
wants to debate it, I would love to hop on a live and talk about notes getting called.
I guess my biggest question is, just to have a good back and forth here, is how would they know how many have not been called if they don't know that they've been transferred over, the notes have been transferred over, you know what I
And it
mean?
also depends on the
Because
state.
it needs
So
to have an audit, right? Like the bank, technically, in most cases, from what I've learned, is that the only way those notes get called due is if they audit the bank. The bank doesn't audit, and then they go and reach out to you.
let me speak to what I know 100% for sure.
Yeah. Yeah.
So I'm going to go Washington State because I've been a broker here. I own a brokerage here. I know how this stuff trades. So if you do a land contract in Washington State, I'm not sure how it appears in Texas. In Washington State on a land contract, both the seller and the owner show up on title simultaneously. One has equitable title, one has legal title.
Mhm.
Do you know if is it the same in Texas?
I'm not sure. My wife's my integrator, so I'd have to
Okay,
ask her.
okay.
Yeah.
I know that's how it works here. I know there are some states where it's more like a car loan, where literally just title changes
Damon
after
would
the
know,
contract is
but
completed.
he's okay.
You can put it like I was a CoStar rep for like years.
Yep.
Easy in CoStar. I can just put alert for anytime title changes on this property. I want an alert, and it will tell me someone's been added to title here. Someone's been removed from title here. I just get an alert. So if I transact, the debt doesn't change. But if I'm the bank, I'm just getting alert that, hey, we lent on this property. There's been a change at title here. It doesn't take much auditing to click my CoStar notifications, and it says there's a new owner on this. I'm like, huh. Once I get like 30 of those, I'm like, would it be reasonable for me to have, I'm the risk manager of a bank department. Is it reasonable for me to ask my minions, hey, can you really quickly look into these 30 properties that CoStar just gave me an automated alert for? It's so easy to look for. I could literally, like, I don't have CoStar access right now because I canceled my contract with them. I could right now hop into CoStar and look at any area, and it would take me like within 5 minutes. I can tell you everyone who's transacted in an area. And if I'm a bank, I can just run that automatically against which properties I lend on. It would take me 5 minutes in a bank to tell me who's doing subject to. It's so
That's
easy.
wild.
It's so easy.
Wow.
Which is
That's
what I
crazy,
worry
man.
about.
Yeah.
That's what
Yeah.
I would be
Oh,
worried
it makes
about.
sense.
You
No,
called
thank you for
out-
sharing. I
Yeah, I
appreciate you
think-
sharing, man.
I think
Yeah.
that's
It doesn't mean most banks don't care. It is
Right.
the long and short of it. And like to Pace's credit, he has a boatload of these. He gets stuff called
Yeah.
occasionally,
Right.
but it's very infrequently that we're seeing that happen. Like I have no idea how many subject twos he has going on at a time, but let's assume he has 100 things. He's probably got like 4 or 5 of them called. Like he doesn't get a ton of stuff called all the time. So
Yeah.
something to keep in mind. I found Washington State. Title keeps saying 1 out of 5. Sounds high to me too, but that is the actual number that I keep getting given. So maybe
Okay.
it's worse than I thought.
I'm curious now, though. You
Candid
got me
about
at my peak interest. I'm interested now. I need to do some research.
Yeah. I would love to hop on a podcast and then Pace just be like, you're wrong and here's why. I'd be like, yeah, cool.
Yeah.
I don't have an ego. I'd love to be wrong about this. This is the data I'm being given by people who do the title work. So
So you don't mind if I throw your name in there when I text them?
dude, you could absolutely do. Be like, hey,
I'm serious now, curious though, but
Be like, hey.
thanks for sharing, man.
Hey, Christian said this, and he also was very complimentary of you. And
Yeah.
Why aren't you texting him back?
So Pace stopped texting me, or we stopped communicating at all. Not that we did often, but he had one video that I disagreed with. One video where he was like, "Hey, pretend you're hopping on a plane," and clearly he was not hopping on a plane in the video. And I was like, well, I mean, or you could just, be honest and just say that you're in a rush. And he just like ripped me apart in the comments and was like, he was like, well, I appreciate you using my name to get views. I was like, no, this is just
Oh, damn.
I was so nice to you, dude. I love your stuff.
That's
And
funny,
my,
dude.
my comment, I think what my actual comment was, Pace has built an amazing business and I respect everything that he's done. His accomplishments are incredible and he knows the space well. I take issue with this particular video. And Pace was just like not having it. I was like, oh shit,
That's funny.
I've lost a potential friend. So yeah,
Well,
tell
thanks
him kind
awesome.
words from Christian. And also
I appreciate that, you man. You've been amazing.
Yeah.
I'm
You've been an amazing
I'm worried
guest.
about sub 2 in the future. And so if he wants to discuss it, I can be very kind and complimentary of his business and still also would love for him to prove me wrong. Would absolutely love it.
Yeah, awesome, man. Thank you so much for hopping on with us, guys. I think we're gonna
absolutely.
wrap this up. It's been a great show. Thanks for diving in and giving us a little feedback, on sub 2 and
Before we
stuff.
go though, Christian,
yeah.
I want you to go ahead and tell
Yes.
everybody
Thank you.
where they can find you, and you also have a mentorship based
cool.
around this process of seller finance for multifamily. And so
Oh yeah,
go ahead
I'll
and
drop
talk
that.
about
Now
it.
Pace
Yeah.
definitely won't text me back. But yes. So I do have a mentorship.
Nice.
We teach creative finance and just the only thing that we do that I think is better than anyone else, I really do, is that it's so simple the way that we process everything. It is very simple the way we built our business, and because it is simple, it is repeatable. Because it's repeatable, it is scalable, and that is what we preach. So that's multifamilystrategy.com. I share everything for free on YouTube. The mentorship is so you can ask questions and you don't have to sort through 1,000 videos to find what you want. It's structured. We have a course, mentorship, multifamilystrategy.com. If you want to just follow, like, hey, I want to learn something specific or recap something from today's thing, I've probably done a video of it on YouTube. It's just multifamily strategy on YouTube. You want to message me, DM me at Christian Osgood. I love answering questions. I will answer questions all day long.
Yeah. Awesome.
Yeah,
And
nice.
I've been through a lot of your videos. They're amazing. You guys go check them out. And then, if it suits what you want to do, look up the mentorship. I'm sure it's definitely worth it. And thank you so
Yeah.
much for coming on, Christian.
Thanks for having me.
We really appreciate your
Yeah,
time.
dude. You're awesome, man.
Yeah. So we'll wrap it there. And Lance, you got any final remarks?
Do you have can you drop our link too, man? I don't have it handy, but if you haven't yet, go follow us or go like and subscribe our YouTube channel, guys. And then if you registered for the event, you'll get an email with the recording every week if you missed it. So definitely go register if you haven't registered yet.
Yes, sir.
Eric, we're wrapping up, bro.
All right. I was just gonna
All
see
right,
if
guys.
Christian could have coffee in the morning.
Yes.
Hey, I'm
Are you-
down in Kelso.
Oh, really? No way.
Yeah.
Oh, cool, dude.
Okay, we should connect. Shoot me a DM at Christian Osgood.
Yep, I already did, brother.
No, there we
Nice.
go. There we go. Awesome.
All right,
Talk to you
guys.
soon.
Peace,
All right,
man.
Christian,
Thanks
thank
a
you.
lot, brother.
Take care.